Hello everyone, welcome to SN Study Station. So today we are going to see about ARR, that is accounting rate of return. This is the second method in capital budgeting, how we can evaluate the investment proposals when we have more than one options where we can invest. So how to evaluate those proposals and which one is to be selected. So accounting rate of return, when we talk about it is a rate of return, means it will tell you the percentage, it will tell you the rate that you are going to get on your investment. Okay, earlier you have seen payback period, it tells us the time period in what time we can get our original investment back. Here accounting rate of return, it is what is the return that we are going to get on our investment, that we are going to see. So ARR uses accounting information as revealed by financial statements to measure the profitability of investment proposals. There is one thing about ARR. There is some return. Suppose a person in a business, a person has 10 lakh rupees. Okay, a person has 10 lakh rupees. He wants to invest this amount. So he wants to calculate ARR. Before that, he is assuming that on this 10 lakh, maybe I will get 20% return. 20% return I will get. 20% return, that means 20% on 10 lakh. 20,000 he will get 2 lakh. Sorry, 2 lakh he will get. That means 2 lakh will be the return. Means 10 lakh a person is investing. So 2 lakh he will be getting in return. So it is this 20% is his it is just what he is assuming. It is assumption only. Okay, so there is some rate which is set by the management, by the businessman. So ARR, when we calculate, it should match this rate. If the ARR is more than this rate what we expected, then we can accept that project. If ARR is less than this rate what we have expected, then we should reject that project. If there are more than one projects whose ARR, suppose you have expected you are going to get 20% return, okay, but you have two options. Let's say one project is giving you 30% return, another one is giving you 35% return. So you should always select the higher one, the one which is giving you higher return in that case. Or if any project is giving you just 10% return but you expected 20%, so you should reject this one. These both should be accepted, but if you have limited money with you, so you can go with the project which is giving you higher return in that case. I hope it is clear. Okay, so about ARR, we have this formula. So ARR, if you will see, let's see the formula. We have two methods through which we can find out ARR. This is the first method that we are going to see today, and in the next video we will be seeing about the second method. So only minor difference is there, you will get to know about it. So ARR is annual average net profit after depreciation and tax divided by initial investment multiplied by 100. In the numerator there is annual average net profit, okay, after depreciation and tax. Means first thing is we need to get net profit after depreciation and tax. Whatever profits are given in the question, we have to check whether it is given after depreciation and tax or not. After means whether the depreciation and tax has been deducted from the profit or not, that we have to check from that. If it is not deducted, we need to deduct that. Both things we have to check because it is net profit after depreciation and tax. So both of these things should be deducted from the profits. Then we will get the net profit after depreciation and tax, and then average we need to find out. If there is only one time profit, that's fine. If every year you are getting some profit, then you have to calculate average for that. So that will be that you can put in the numerator, and then denominator it is initial investment. So initial investment is cost of asset minus salvage value or scrap value. Either it is salvage value or it is also known as scrap value. So this you have to deduct from the cost of project which is given in the question. Okay, means what amount we are going to get when we are going to sell that project after the end of its life, sell that asset after the end of its life. That will be scrap value that we have to deduct from the cost of asset. So this is how we are going to solve questions based on ARR. So let's see the question, then you will better understand it. Okay, see here, this is compute ARR from the following data. We have to calculate accounting rate of return. Cost of asset is 5 lakh, useful life of the asset is 5 years, CF80 is 1,80,000. Okay, talking about CF80, you already know about CF80. It is cash flows after tax. If you remember that in payback period, we have solved various problems on this CF80. So CF80 is cash flows after tax, and if we talk about CF80, it is profit after tax plus depreciation. Okay, and let me write the formula first, so you will get to know what you need, then you can calculate those things. So for ARR, we have the formula, that is annual average net profit after depreciation and tax. Okay, and divided by initial investment and multiplied by 100. This is the formula. So first we need annual average net profit after depreciation and tax. We have this profit 1,80,000, but here depreciation is added, it is not deducted. We need after depreciation and tax. This is profit after tax but before depreciation. Okay, so we have to deduct depreciation from this profit, then we will get net profit after depreciation and tax. Okay, so here depreciation is not given anywhere in the question. If you see the question, depreciation is not given, but you can find it out easily. For depreciation, simply, okay, here I'll do the working notes calculation. Depreciation, its cost of asset is 5 lakh, right? 5 lakh is the cost of asset and its life is 5 years. So this we can divide, cost of asset divided by its life. So we get 1 lakh depreciation. Each year we are going to get the same amount. Okay, so 1 lakh is the depreciation. Now for getting net profit after depreciation and tax, we need to take this CF80, that is 1,80,000, and deduct depreciation from this CF80. So we will be getting 80,000. 80,000 is the net profit after depreciation and tax. It is net profit after depreciation and tax. This we will keep it in the numerator. I hope it is clear, because one more thing here, average we don't need to find out, because only once there is profit, means for 5 years they have given profit once. If every year they have given profit, so that we'll see in the next question. So first let's see this question. Okay, so profit was given after tax but before depreciation, so we have deducted depreciation. Now we got net profit after depreciation and tax. Now for initial investment, what do we need? Initial investment means we need to subtract the scrap value from the cost of asset. So cost of asset is 5 lakh and scrap value is not given, so there is no scrap value. So we'll take this 5 lakh as the initial investment. If scrap value is given, then deduct it, otherwise take that cost of asset, take that initial investment. Now you will get here, just calculate, you will get 16% as ARR. 16% is the return that is going to be get on this project with the cost. The project cost of asset is 5 lakh, its life is for 5 years, and profits is 1,80,000. So like this we can calculate. I hope it is clear. One more question that we can see, then you will better understand this ARR. So here it is, here there is a project which gives investment of 25 lakh. Means 25 lakh is the initial investment. It's the cost of asset or cost of project or initial investment, original investment. It has various names, but it's the same thing, 25 lakhs. And it gives profit after depreciation and tax. Just read the statements properly. Here they have already given us profit after depreciation and tax, not before. they have already given us profit after depreciation and tax. So we don't need to subtract depreciation or tax because these both things are already subtracted here. Only what do we need? Okay, here the profits are different in each year. 1 to 5 years there is different profit, and at the end of fifth year the plant can be sold for rupees 1,50,000. You have to find out ARR. So this 1,50,000 is nothing, just the scrap value. So if we have to note down the things, it means initial investment, if we want to note down, so that is 25 lakhs minus 1,50,000, so that is 1.5 lakh. Okay, so we will be getting here 23,50,000, because in denominator we need initial investment and it is cost of asset minus scrap value. So this 1,50,000 is a scrap value, because 5 years we are getting profit, and at the end of the 5th year the project life will be ended. So this value we are still getting with that investment. So this is the scrap value. So this initial investment we got for our denominator. Now for numerator we need annual average net profit after depreciation and tax. Net profit after depreciation, they have already given profit after depreciation and tax, only we need to find out the average. So you have to add all these 5 years profit and divide it by 5. So when you will be adding this 5 years profit, means 2 lakh plus 3 lakh plus 5 lakh plus 5,20,000 plus 3 lakh 20,000, all these has to be added. Okay, I'll write here. First year 2 lakh, second year 3 lakh, third year 5, fourth year 5.2 lakh, and fifth year 3.2 lakh, divided by, because 5 years are there, so divided by 5, we need to find out an average. So we will be getting 3,68,000. Now we got both the values. This is denominator value and this is numerator value. Okay, like this we need to find out ARR. So ARR is annual average net profit after depreciation and tax, that is 3,68,000, divided by initial investment, that is 23,50,000, multiplied by 100. So we will be getting here how much percent? 15.66 percentage is the ARR that we will be getting. This is the return that we will be getting on this project. Okay, so like this you can calculate ARR. If there are more than one investment options have been given, then you can find out ARR in all those. Suppose 2 options, 3 options are given. Okay, so you can calculate ARR, and the one which is giving the highest ARR, highest return, that one can be selected. That one can be the best option. So I hope this method is clear to you. Just see what do you need in the numerator, what do you need in the denominator, calculate those things and then put it in the formula, you'll get the value. So for numerator we need annual average net profit after depreciation and tax. You need to check whether depreciation and tax, both things are deducted from the profit or not. If not deducted, then deduct it, whatever is not deducted. If one is not deducted, then do it, and if both are not deducted, then do it. Or if like in this question both were already deducted, so we don't need to calculate profit after depreciation and tax, that was already given in the question. And then that is average, annual average net profit. So if profits are different in each year, then we have to find out average. If it is same, then that will be same only we need to take. Okay, then denominator we need initial investment, and initial investment is about cost of asset, and if the scrap value is given, then we have to subtract the scrap value from the cost. So here we got 23,50,000. Like this we have to solve the question. In the next video we'll see second part of ARR, second method of ARR we will be seeing. So stay connected. Thank you.